Did you know that 90% of individual stock investors underperform the market and many actually lose money? So, why are people still doing it? Let's talk about why buying single stocks might be one of the worst financial decisions you can make. Welcome back to Simply Money. Sure, picking the next Amazon sounds exciting. The idea of getting rich off one big win is appealing. But what if I told you that the odds are stacked against you and most people never see that win? Here's the hard truth. Individual stocks are risky. Unlike diversified investments, you're putting your money in the hands of one company, one leadership team, one business model, one earnings report. And if something goes wrong, your investment could drop 10, 20, even 50% in a day. Market volatility isn't just a theory, it's a reality. Remember Netflix's stock crashed in 2022 after one bad quarter. That wiped out billions in value overnight. You can do all the research in the world, but you still can't control the market reaction. There are three main reasons why individual stock investing is a terrible idea for most people. One, the lack of diversification. When you invest in a single stock, you're not diversified. If that stock tanks, your portfolio takes the full hit. Compare that to an index fund which holds hundreds of companies. One fails, no big deal. Second, emotional decision making. Stock investing brings out our worst instincts. People buy high out of FOMO, fear of missing out, and sell low out of fear. It's easy to say you'll hold for the long term, but much harder when your investment is dropping by the hour. Third reason is predicting the market is nearly impossible. Professional fund managers with teams of analysts and access to inside data still fail to beat the market. What makes you think you can do better with a hunch or a TikTok tip? Here's the kicker. Studies show that the average retail investor earns about 4% annually, while the S&P 500 averages around 10%. That gap is the cost of trying to beat the market with stock picks. Instead, smart investors focus on broad index funds like VOO, SPY, or VTI. These track the overall market and let your money grow steadily without the wild roller coaster of individual companies. Individual stocks might seem exciting, but for most people, they are a trap. Diversification, discipline, and a long-term strategy will get you further, and with less stress. Have you ever lost money picking stocks? Let me know in the comments. I'd love to hear your story. What stock did you pick? And why did you pick it? And what happened to it? Share with the community below. I shared in other videos about in the 80s how Sears and Kodak were great stocks and full of hype. Kodak was coming out, but they didn't keep up with the digital technology that came out, and they went belly up. Think about Blockbuster. Back in the 90s, everybody was going to Blockbusters. There's not a single one left. Big companies can boom, but they can also bust. And putting everything in a single stock can cost you a fortune. Share your story below. It helps the community, helps others see the mistakes we've made. It's okay to share our mistakes so others can learn. We're here to build the community up and help others reach financial freedom through smart, disciplined investing. I hope you enjoy this video. If you do, hit that like button. It really helps the channel out, and I do really appreciate it. Don't forget to hit the subscribe and the bell notification so you're notified of future videos when they come out. And we'll see you next time on Simply Money.